You're such an asshole.
Hey everybody, the old captain here. Today we're going to economics, and this young man has, basically his question is, how the heck do we end up getting wheelbarrows full of money? Like, what are the processes that occur that all of a sudden, like, oh shit, the economy went to hell, or the stock market is collapsing? Why does that immediately translate into me carrying wheelbarrows full of money? Well, it doesn't happen immediately. It does take some time. And you kind of notice this if you look at inflation rates in Venezuela, or when it first started being inflation rates in Venezuela, Argentina, and all that, Brazil, you'd have an inflation rate per month about 10 to 15%, and then that actually accelerates. So it's not like the stock market crashes and then 10 minutes later everybody's out there with a wheelbarrow full of money. There's a delay, and all these processes have to happen to occur. So I'm going to go over them, but keep in mind it's not lightning striking like that. It takes a little while for these perfect storms to collide and brew. Hey, Mr. Asshole, I got a general economics question that I would like for you to answer in a video. The first time I ever heard of the Weimar Republic, its hyperinflation, was when I was in elementary school, and our history teacher was telling us about the aftermath of World War I and the Treaty of Versailles. She told us the story of people taking wheelbarrows of money to the store to buy bread, or even burning money to keep warm. Sometimes they use them for wallpaper. Fast forward to 2016, how would hyperinflation manifest itself today when most of the money, M1 through M3 money supply that exists, isn't actually in paper form but is electronic zeros and one? And how would large sovereigns or institutions that dump our bonds affect the average Joe on Main Street in America? Walmart gas stations and the liquor stores only accept Federal Reserve notes as a mean of exchange, not 10 treasuries. How would massive bond dumping turn into me needing the Tony Montana money counter to buy bread? I've heard of the helicopter money as a possibility, but they've already tried that 78 years ago when they gave out $600 to $1,200 checks to everybody, and that didn't work. Thanks, we'd like to remain anonymous. All right, let's go through your questions individually here. How would hyperinflation manifest itself today when most of the money is not in actual paper but is electronics, ones and zeros? All right, well, it already is happening today, and the only reason we don't say we have inflation is because it's not in our consumables. The way we measure inflation is with the Consumer Price Index. We do not look at asset prices. And people say, well, should we? That's a separate, different debate. If you look at asset prices, they've gone up. What I mean by asset prices, I mean stocks. Stocks have gone up tremendously. They've doubled since the crash back in 2007 or so. But our productivity and profitability hasn't doubled. Housing, that's gone up tremendously since it's hit the crash, right? Did rents go up by 50%? No, but housing sure has. And and then tuition. Tuition, even though not necessarily an asset, it is an investment. And you say, well, why is tuition going up? So inflation is occurring. The question is how? How is it occurring? Well, the way it's occurring is through those ones and zeros. If you went to college, did Uncle Sam give you dollar bills to go and pay your tuition? No, they lent you money. You took that money, you paid it. You never saw the money. Housing, do you pay your mortgage in cash? No, chances are you don't. And stocks, do you pay your stocks in cash? No, it goes from your check, you take it out of the 401k, or your paycheck, it goes into the 401k, ends up in the stock market. Now, all three of these are not unrelated. And the reason they're not unrelated is because more or less all the quantitative easing money that has been printed off by, quote, printed off, but added ones and zeros, has gone into these markets. And if you look at it, it's usually we're either borrowing the money from the government in the case of tuition, or it's just money being printed off in central bank policy, low interest rates, where corporations are borrowing it, and they go ahead and invest it in the stock market, either to buy other companies' assets or stocks, or to buy back their own. So this has driven stock prices up. And then housing, we'll just recapitalize the entire banking system. And if you look at TARP and what the Federal Reserve has been doing, it's basically just been printing off money and buying all the banks' shitty assets, like their mortgages and their bonds that they lent out to stupid people. And now they've recapitalized the banks. So the banks have all this money. And surprise, surprise, with all this money and low interest rates, what do banks do? They lend it out at very low interest rates for cars and houses and all that other stuff. So there is inflation. That's how the money, albeit ones and zeros, not actual paper currency, is ending up causing inflation. And healthcare, that's another one. There's healthcare. I forgot to mention that one. So some of your most major expenses, if not the most major expenses, healthcare, housing, education, and healthcare, housing, education. What is the other one? Oh, and the stock market. They've all gone up tremendously. Not hyperinflation, but certainly at your 10 to 12% rate of return per year. So the inflation is already here, and that's how it's going to happen. Now, what you're probably more concerned about is how does it affect, and you mentioned it here, Walmart gas stations, how does it affect average Joe on Main Street? Now, the funny thing about average Joe on Main Street doesn't really have a lot of assets. The average Joe has maybe like a week's worth of money. Everyone's living paycheck to paycheck. Their houses are mortgaged to the hilt, so they're not really going to lose out on net worth because they have no net worth to lose out on. But where they are going to lose out is what little savings they do have, and they're also going to lose out on their jobs in the economy. So how would institutions dumping bonds affect the average Joe on Main Street? All right, now, understand, if the pensions, institutions, mutual funds are dumping U.S. government bonds, something happened really bad to the government. It didn't pay. So in other words, this presupposes something very bad has happened to begin with. Now, but regardless, let's say we sell, CalPERS starts dumping U.S. government bonds. Okay, now the market is going to go in the shitter. It's going to be like, holy shit, what the fuck just happened? It could be anything, but they're selling government bonds, something bad. That's going to trigger panic. That's going to trigger selling, and stocks and bond prices are going to go down. Now, this will also then result in companies losing money because their investments are going down in value, and a lot of companies borrow against it. And there's also a lot of financial institutions that have bets they've taken on this in the form of derivatives. So if there is a large crash in the stock market, this will have a contagion effect. It will spread to the larger economy, and the economy is going to rapidly slow down, if not outright contract. Now, this will trigger some other things. Most likely because the financial industry is very important. It's like the heart of the cardiovascular system of the economy. If the banks shut down, nothing's getting done. This is why they bailed out the banks, whether you like it or not. That's why they did it. We got to keep that heart pumping. So there would be another bailout, or more likely a bail-in, or what they would call a haircut, where they basically just confiscate your savings like they did in Cyprus to recapitalize the bank, recapitalize the government, cut the deficits. They might nationalize, meaning steal your 401ks, IRAs, your retirement funds. And then that would also then have an effect on your finances. You probably spend less. You probably be in a panic mode. You probably make a bank panic. You'd run to the bank and try and get what money there is. Then as the economy slows down, you're going to have a contraction, which means there's less stuff being produced. Now, this causes inflation in two different ways. One, with less supply, prices go up. So there's the same amount of money, but less goods being produced, so you're going to have an inflation occur because of that. This is where you might see not as many things stocked on the shelves. It wouldn't be like Venezuela at first, but you might be out of your favorite cereal. One of the gas stations might not have gas. Okay, this is the beginnings of it happening. The other way inflation would occur, but it'd be occurring anyway if the U.S. government was having its bonds sold, is the dollar would be collapsing against foreign currencies. And anything that we would import would go up tremendously in terms of cost. So we'd be importing the gas from Saudi Arabia would be very expensive. All the shit we buy from China would be very expensive. Anything that's being imported in this country, that would cause inflation as well. So that would have an effect on your consumer goods, your oil, your trinkets that you buy at Walmart, everything that you see in your food. That would, this perfect storm brewing, and a collapsing dollar and panic, that would start triggering higher prices and inflation. Now, let me get to the next one. How would massive bond dumping turn into me needing the Tony Montana money counter to buy bread? I heard helicopter. So how does that happen? I had to kind of sit and think this through because it's multiple things happening at once. All right. We once again assume that if we're selling government bonds, something bad has happened to the U.S. government and the dollar is collapsing. So once again, we get that imported inflation. All these financial institutions that are selling government bonds and have borrowed against it, which is pretty much all of them, they would be posting losses. All the companies that are also invested in them, because you have cash and investments and subsidiary investments, they'd start to lose money. Their prices are going down because the stock market is collapsing. They start with liquidating those investments because they need cash. Cash is king at this point. So everybody's starting to convert everything to cash. On top of it, as we mentioned before, with losses being occurred because they're losing money on all their investments, they're going to lay people off. Okay? Now people are on unemployment. They're not producing any goods. That means lower production of goods, so there's going to be this, at minimum, the same amount of money. This assumes the government is not producing shit in terms of printing off cash. There's going to be less goods produced with the same amount of money floating around in the market. So you're going to have an immediate, not necessarily immediate, but you're going to have an immediate bout of inflation due to happen there. What else? This sends into a spiral like, oh my gosh, we're in a recession. The dollar collapses even more. We import more inflation. Your cost of goods, not just in terms of consumables, are going to have final products that we import from China, but the cost of raw materials that we import as well. And domestically by this time, because inflation has started to seep in and everyone's charging more, that goes into the cost of production, increasing prices as well. Now, the main, though, source of, at least at the beginning, like say stage 2, everybody's trying to liquidate their assets. All right, then they get the money, and then they go pay off whoever they owe that money. Now all of a sudden you got banks with money, or you got people with investors with a ton of money that's no longer invested and tied up in the stock market. Now what are they going to do? Well, if panic is setting in, and it might be in a true collapse, especially if the dollar is collapsing and people are shorting government bonds, they're going to run and try to buy commodities, something that keeps its value. So they're going to buy, and this is where we start getting the wheelbarrow thing, because what they would do is sometimes they would let you off halfway through the work, give you half your pay through the day, give you half your day's pay, you go buy something that has value, bread, a table, anything, then you go work your next day, get your next half a paycheck, which had gone up maybe by 100% that time, and you buy something that you can on that. That even slows down the economy as well. But now all of a sudden you have a bunch of people, quote, investors, looking for a safe haven. And so they're going to start buying anything that has a store of value. Precious metals would be going up. They'd be buying commodities, oil, steel, whatever else. And once again, driving up the cost of production because we need that stuff. And then that would translate into you needing a wheelbarrow full of money, inevitably. And then if it gets really bad, they'll just buy anything they can that has value because the dollar is collapsing that much. They don't want to even lose 20%. They'll go buy a car they don't need. They'll go buy something. So all of a sudden there's this huge demand where money was sitting tightly, doing nothing, invested in an asset that was paying its whopping 2% dividend yield a year. Now you got trillions of dollars chasing whatever goods may exist out there so it can be maintained as a store of value. And so now you're going to go into hyperinflation territory by this stage 2, stage 3, 2.5 type stage. Now, the economy is starting to collapse, or it is contracting considerably. And so there's less goods, there's less supply being produced. But then also, people still need to eat. They still need some kind of food. And so the government, in all of its wisdom, will keep this bubble going, and it will just simply print off money. It can't borrow money because no one's lending it money anymore. They're selling bonds. No one wants to lend the government anymore. It can't tax because the economy is about 20% or 50% the size of what it used to be. So guess what it's going to do? It's going to do what every stupid motherfucking idiotic cocksucking piece of shit ever did, and they're going to just print off more money. Just what they're doing in Venezuela, what they did in Argentina, Brazil, every place, the Roman Empire even. We're just going to print off more money. They give the money to the people. And soon you got to do this every week, likely, maybe even every day. And we could do it with helicopters, with actual physical cash. Chances are they're just going to print it off at the Federal Reserve, tack on a couple more zeros, and they're going to they're going to make a deposit into your checking account, which they just stole from earlier, or they're going to start handing out EBIT cards of certain things, or it'll be like a Walmart card, but it'll be the federal government, it'll be acceptable anywhere. And you'll be able to say, but then price, because they're printing off 300 million people every day? What does it need to float a person every day? Oh, well, with housing, you're probably going to need a little bit more. Let's say $50 a day. Let me do the math. Bear with me. I'm just seeing if my back and napkins in the brain, my calculations are working. 300 million people times $50 a day. Come on, Clary, put an equal sign in there. So that's 300 million, that's 15 billion a day equals that, times 365, that's 15 billion. No, that's not the way. Let's do it a different way here, guys. Come on, Clary, get your act together. 16 trillion, 16,000 billions. Equals 16, 3, divided by 300. 16 trillion. Trillion, billion, million. There we go. Equals that divided by 300. 53,000, that's about right. Equals that divided by 365. Oh, $146 a day. Is that how much is needed? I guess it is. $446 a day. Equals that times 300. 43 billion? I think that's right. I think my math is right. The government would have to print off $43 billion a day to keep everybody alive, to have that money coming in. Now, it probably wouldn't be 43. This would assume no production. But $44 billion a day would have to be produced to keep the population alive and going. Although now I'm wondering about that. A whole shit ton of money is going to be printed off every day is what I'm saying. And with economic production going down and the government just throwing money on there so people can buy, now you can see where hyperinflation takes off like a tornado. You are printing off tons, billions of dollars a day, at least billions of dollars a day. And you are producing less and less. So now you have all this money, this money supply increasing dramatically with the amount of production dropping dramatically. And now you have the perfect case for hyperinflation. But once again, it probably won't happen with, Barack Obama coming in, oh, here's what we're going to do for the folks. And it gives you money. That's not going to happen. It's going to be a card. You'll have an account. Some money will be deposited in there every day. And then you'll go out and shop. Well, you'll stand in line, so there won't be anything to shop for. And that's the problem with socialism. Is sometimes there's just no goods being produced anymore. And then you have empty stock shelves. So that's great. You'll have this purchasing card, but there just won't be anything to buy because we ignored supply-side economics. Anyway, that's a separate thing. So, hope that explained it. Hope we all learned a little bit about economics, how we go from a normally to, oh my God! And you're carrying digital wheelbarrows full of money and a conveniently made credit card. That assumes the economy is still functional enough that you could create a credit card and the electricity system is running that you could run it. Once that goes down, then yes, then you will need wheelbarrows full of money. There's the irony. Best of luck to you. Toodles.